It's been a turbulent week on the markets, and all driven by the mixed signals coming from the US economy. Wall Street earnings and a manufacturing rebound are pointing up, but Main Street is not so buoyant. With unemployment high, credit tight and the housing market wobbling, the US consumer is reluctant to spend. To discuss this a little further, I spoke to Tom Callan, MD of Blackrock Global Opportunities. Tom Callan, thanks for joining us this evening.
Sure, my pleasure.
Is the US at a tipping point?
I don't know that it's at a tipping point, but I would say that the risk of a double-dip recession is increasingly likely. The lead indicators, the ECRI leading index growth rate, is declined to a -10, which has, pretty much 100% accuracy in forecasting recession. So. That said, I would also like to say, I don't think it would be anything near as severe as what we've seen last time, insofar as a lot of sectors like housing, like autos, are also, running at levels that are well below peaks, 40–50% below where they were pre-crisis.
Now, you're in favour of stimulating the economy. Stimulate back to what?
Well, I think that the biggest issue for the U.S. is the overall debt to GDP levels that we have. So, I think that there are only two ways to restore that to balance. Currently, the debt to GDP is 370%, and in the last 30 years, that's up from 160%. So a huge increase in the debt load. What we think might be a sustainable level is something more like 240, and I think that the preferred policy prescription would be to try to reflate the economy, to try to drive nominal GDP growth rather than experience debt deflation, which would clearly be ruinous for the financial system and for the average American.
So in that sense, I know that you've been talking about changing consumption and investment psychology. What do you mean by that?
Well, I think that right now, I think that corporations, if you look at their balance sheets, they have higher levels of cash than they've had since the 1950s. Free cash flow yields are higher than they have been in decades, and I think they're all indicative of companies that are not hiring and are not investing. Banks similarly have greater cash balances than we've had any time since the early 1980s. Evidence that they have not been lending, and very little evidence that they're even loosening their lending standards. So I think that what we need to try to do is to get people to say that my cash won't be more valuable tomorrow, that there's even the risk of inflation, and so better that we invest and spend today than tomorrow.
But how do you encourage them to spend now when they're still carrying large mortgages and paying off that debt, and also getting them to spend without going into more debt?
Well, I think at first it has to come from the corporate sector. I think that we need to get them to make investments in the future. I think we could, the fiscal stimulus that I think would be, reasonable for the administration to do would be targeted tax cuts for hiring, altering depreciation schedules, so companies would be encouraged to invest in capital equipment sooner rather than later. That would have the effect of putting people, back to work, and then once you get the employment situation growing, some nominal wage growth could then help them in the future spend more. But you do make a very good point. I think that the average American doesn't really have the flexibility to spend more currently, and probably won't for the foreseeable future.
Now, before you go, Tom Callan, you've been visiting Australia. What are your thoughts on the economy and how Australia's fared out of the GFC?
Well, Australia has been one of the few bright spots, in part because it's been, one of the China, obviously, and even India, very big growth markets, and with all of the hard assets here, the mining companies in particular, Australia has done very well. And I also suspect that, in a reflationary environment, with quantitative easing in the U.S. and a weaker U.S. dollar, that would also be very good for Australia.
But is Australia too reliant on China and the mining? We often forget that the US is still the world's biggest economy. And how affected will Australia be if the US goes back into another recession?
I do think that with every downturn, the world economy is less dependent on the U.S. than it was before. I think, right now, just looking at Germany as an example, they just posted 2.5% quarter-over-quarter annualized GDP growth on the back of exports. Their exports to China are well ahead of the 2007 levels. They're indexed. If you index their exports to China, same thing for India. Exports to the U.S. are below where they were in 2007. So I do think that yes, the U.S. isn't unimportant. It's one of the largest. It is still the largest economy in the world. We still have export markets that can help maintain growth, in other parts of the world.
Tom Callan, we'll leave it there, but thanks very much for joining Late Line Business.
Bridget, thank you for having me.